and welcome to today's Broker University webinar. Arizona Realtors is proud to bring you this monthly webinar series designed exclusively for our brokers to learn fresh insights on current topics from their peers. I'm Callie Waterhouse with the Arizona Association of Realtors. As I mentioned before, today's webinar is all about trust accounting and compliance with experienced property manager Mike Mumford. Mike has been involved in property management since 1996 when he joined Bennett Property Management, and I'm not even going to count how many years of experience that is. Wow. Okay, so Mike was the local NARPM chapter treasurer, and I think as we get started, he's going to explain a little bit about NARPM and what that means. He holds the RMP and the MPM designations, which I did some Google research, and wow, that is very impressive.
Oh, thank you.
Not a lot of people hold those designations.
Yeah, it's not very many.
That's very good. So Mike was instrumental in becoming Arizona's first CRMC recognized company, and I'm hoping he's going to explain that a little bit more to us. He's a certified NARPM instructor, and he teaches classes throughout Arizona. So when I say that we're really bringing the best of the best to our members, I can honestly say Mike is going to bring the best game for you guys today. Mike's presentation is going to be about 40-45 minutes long, followed by about 15 minutes of Q&A. So we encourage you to ask your questions. This is an expert sitting here with us, folks. So if you have questions about trust accounting, compliance, record keeping, this is a great opportunity to get those questions answered by a reliable source. So we're going to get started right away. And Mike, I'd like to say welcome.
Thank you. Appreciate you guys having me, and hopefully we'll get some good information out to everybody. Excuse me. As far as NARPM goes, NARPM is the National Association of Residential Property Managers, and I would highly encourage you that if you are in the property management industry, you should check that out. There are 4 chapters in the state. There are 2 in the Phoenix metro area, an east side and a west side. There is a chapter up in Prescott, northern Arizona, and there's a chapter down in Tucson. So no matter what part of the state you're from, there is a chapter there, and you have a lot of information, a lot of education. Their focus is on fee-based single-family home management. So it's not like the AMA or some of the others that are focused on multifamily or apartment complexes. It's strictly focused on the 1 to 4 and single-family home management. So that's a great resource. It's one of my favorite resources. I teach for them. I also teach for the state, and their focus on education is wonderful. So I highly recommend finding out about them, Googling that. You can always email me, and I'm happy to get back to you. I am on the slate to be next year's regional vice president for NARPM, which covers the 4 corner states plus Nevada. So I am very actively involved and would be happy to talk to anybody about that. I wanted to talk about the ADRE source too. I don't know if many of you have gone to their website recently, but there's been a big push and a big focus on property management, particularly trust accounting. There has been over $5 million missing from trust accounts just in the last 2.5, 3 years. So it's a huge deal. The department is focusing on it very heavily. And one of the things that I'm very encouraged to see is that they're focusing on education, not just auditing and compliance. They are focused on making sure that the right information gets out to those companies that are trying to do it right. One of those things I put here, I just copied and pasted this directly from the ADRE site. The audit package, the trust reconciliation stuff, the law book, there's so much new information out there. This is out there within the last year. So if you haven't gone for a while, please go, please download these PDFs and take a look at that. The accounting reconciliation, how-tos and forms is just, it's wonderful stuff. So I wanted to get that out there first to make sure that there's a bunch of sources out there that are new you may not be aware of. So make sure you go to the site and take a look at those. It's where a lot of the information from my presentation came from. Also, our company has been in business for 40 years. We have been audited several times. We make the honor roll each time that we're audited so far, and try to do it right and do a good job with that. So this does come from real life experience, managing over 2,000 units and $2.2 million worth of rent coming in and out of the account every month. So I'm happy to go over that stuff with you and let you know what mistakes we made. So hopefully we can help you not make those in the future. What we're going to cover today: record keeping, trust accounting, accounts receivable, accounts payable. Those are the four main subject matters we're going to cover today that regard trust accounting. Let's jump into record keeping. So ADRE has several record keeping requirements and retention periods. You can find those at ARS 322151.01. Tells you what you have to keep and how long you have to keep it. I want to make sure when we talk about record keeping that the department is not the only entity that requires you to retain records. You have several other entities, the IRS, the federal government, fair housing, that require you and may have more stringent rules, and we'll kind of go over those as we go through. Employment files. You're required to keep files on employees, current and former, 5 years. So 5 years from termination date, you do have to keep those. You have to have those on hand. Those should include either an independent contractor agreement or a employment agreement if they're employees. Sometimes if they're licensed agents, you'll have independent contractor agreements, but it should cover what you expect from them, what they're allowed to do, what they're not allowed to do, and make sure you have that in the file. In addition to that, you need to have a W-9, you need to have an I-9, you need to have, if they're a salaried employee or an hourly employee, a W-4, so that you have that on file so you know what the deductions are. You're required to keep that. That's federal law that requires you to do that. For property management agreements, you're required by statute to keep a log. The log can be either consecutively numbered or orderly in an easily accessible system. I know many companies just keep a spreadsheet, and they, as new management agreements come in, they just type that into the log, and that's perfectly acceptable. Other ways would be to have it based on the owner's last name, based on the year that it came in, based on their property address, but any orderly system is okay as long as you make sure that you keep a log and you can produce that. When the auditors come, they will typically ask you for all the new accounts that you have signed up in the last certain amount of time, 3 months, 6 months, and you'll need to produce the log. So, property management agreements, PMAs, those are required to be kept in each unit folder. You are required to keep a separate folder for every property that you manage, every door, and the management agreement is required to be kept in that folder. After you terminate management, you're also required to keep that for 5 years after termination. Residential leases. Those, again, are required to be kept in the individual unit folders. They have to be numbered or in a systematic manner. Typically, those are put in by address and managed that way, but they need to be in some type of systematic order so that when the auditor comes and asks to see 3 or 4 of those during the audit, you'll be able to pull those out. Residential leases are required to be kept for 1 year from expiration. Again, financial records are required to be kept for 3 years, so you may want to hold those for a little longer to make sure that you're covered for any financial stuff. Denied applications, usually considered rejected offers, those are required by the department to be kept for 1 year. But if you talk to the company that pulls your credit and criminal reports for you, they usually require you to keep those for 5 years. So make sure you check with whoever is pulling your credit and criminal. It's very important that you have that. If you have any kind of fair housing complaint, any kind of fair housing audit, they're going to come in and they're going to ask to see your denied applications for the last 5 years. So make sure that you have those. Again, like we talked about, there are a lot of different entities that come and audit us and track us and that we have to comply with. EPA, HUD, all the different ones. So make sure that you've got that covered for your record keeping to the latest amount on those. Financial records, again, 3 years. IRS says 7 years. So make sure you're covered on that, especially for your company financials. You need to keep those for 7 years. Anything to do with your corporate books, bills you've paid, and that. The department says for financial records for the properties that you actually manage, you have to keep those for 3 years from the termination date. So keep those on hand and make sure you have at least 3 years for people that you're managing. And those include trust account reconciliations, bank statements, and that. The bank's website for pulling copies of canceled checks and pulling bank statements is not an acceptable source for filing those. You have to have either digital copies or hard copies in your office. Yeah, logging on to wellsfargo.com or bankofamerica.com to pull those up is not okay. You have to get copies of canceled check back. Now, most banks will send those to you either on a CD, a PDF. They'll even print them on the back of your statement, depending on the size of the company. You have to do what makes sense for you. If you're writing thousands of checks every month, getting actual canceled checks back is a little tedious and takes up a lot of room. So talk to your bank, find out what they can do for you. Our bank emails me a PDF with a copy of every single canceled check front and back every month. I store those on hand. I have those stored on a hard drive in the office. Anytime the department comes in, I can pull those up and just give them a copy. So records must be kept in the principal office or a licensed branch office if you have a branch office. Off-site location is okay, but you have to have prior written notification, and it has to be within the state. Again, when we talked about canceled checks and bank statements, I know for a fact that Wells Fargo, they store a lot of their stuff in Minnesota, and that's not within the state. So storing those at the bank is not okay. It's not within the state. It doesn't meet up with the statute. Digital record keeping, we talked about that with a bank website. Non-residential leases have different requirements about record keeping, and we don't do non-residential or commercial, so I'm not going to go into that. But if you do that, make sure you're following the statute. Those are required to be held for a little bit longer and do require broker signatures on that. The other thing one of the auditors prefer is if you're going to be paperless, that you be all paperless. If you're going to be paper copy, be all paper copy. It's just much easier for them to deal with. I don't think there's a statute requirement on that, but you do want to make sure that you're making the auditors happy.
So if somebody is doing some electronic transfers and some checks?
Yeah, electronic transfers are fine. You just need to make sure, so typically on a bank statement, if you do a large ACH that's pushing money out to, let's say, 200 different owners, on your bank statement, it's just going to have one transaction that says $75,000 ACH. It's not going to have those details. We're going to go over that in a little bit, but you do need to, you're required to keep the backup information for that, to just say what it is and why you made that transfer, where the money came from, where the money went to in those. And that's perfectly acceptable. We're getting more and more online with our banking. We do transfers a lot instead of checks. That's fine. The requirements for the backup documentation is the same. The documentation is the same. Either digital transfer, ACH, wire transfers, any of that stuff, you're still required to keep the same amount of backup information. We'll go over that towards the end of the seminar. So good question. Thank you. Let's talk about the money in the bank. This is one of the biggest things. Like I said, over $5 million missing, and some people it's just because they didn't know what they're doing, and other people just willfully stole the money. It happens, and there's not a lot you can do to prevent that. But there are a lot of people that were missing money and just didn't realize they were missing money, didn't realize that the requirements that they had to do the banking and what they're required to do and how to even prove that they have the right amount of money on hand. So let's go over a little of that, talk about reconciliations and three-way reconciliations. Let's talk about setting up your accounts, who's allowed to sign, and how to use a trust account. Setting up your accounts is critical. Trust account definition just means it's other people's money. If you have other people's money, general trust accounting rules say that you should have that in a trust account. Contrary to popular belief, there are lots of different types of entities who use trust accounts. Lawyers use trust accounts all the time. If you give a lawyer a retainer, that has to go in a trust account because it's not his money. He hasn't earned that money yet. He's holding that money on your behalf until you use that. It's just ready to go whenever you need that. So trust account rules are standard across the board. Property management and real estate, and particularly Arizona property management and real estate, have some specific things that are required. We're going to go over those. FDIC, Federal Deposit Insurance. That's covered for $250,000 per account normally. In trust accounts, it is per account holder. The department requires that all trust accounts, all other people's money, must be in an account that's federally insured. For a time when interest rates were better, a lot of people were getting CDs, earning some interest, which is perfectly legal, They were doing sweep accounts, savings accounts, lots of different types of accounts to earn a little extra money on the money that's just sitting there. Be very, very wary and make sure that those accounts are federally insured. They have to be FDIC insured. I know most of the sweep accounts are not. That people aren't doing those now. There's no money in sweep accounts. But when the interest rates were high, there was. If you choose to do that, again, it is legal. You have to disclose to your owners if you are going to make money on their money, interest-bearing accounts, you must disclose how the interest is being distributed. If you don't tell your owners that you're retaining that money, then you potentially would have to give that back to them, and that's not fun for anybody. So make sure you cover that and have that in your management agreements. Talked about trust account protection from FDIC. It also protects you if you're involved in legal action, become incapacitated, or die. The funds are insured for each depositor in there. And because it's a trust account, there are different rules about getting money out of there. If you have a personal checking account and you pass away under some, whatever circumstances, there's a chance that those funds will be frozen, which means you wouldn't be able to pay any employees, wouldn't be able to pay any vendors, and most importantly, wouldn't be able to send any owners their rent money. They get a little upset about that. So make sure that that's covered. Make sure that you have those set up properly. Now, I've heard from lots and lots of property managers that banks are either refusing to set up trust accounts or giving them a real hard time even understanding what the trust accounts are. This website is from the state of Nevada, and their real estate department in Nevada came out with this memo offering straight to banks about how to set up a trust account, what it is, how to word it, and that. I found this very helpful. I know some people here in the state have found that helpful. So just another document to give to your bank when you're going to set up a new trust account. Also, if you're setting up trust accounts, changing banks, setting up new accounts, you're required to notify the department. I believe it's within 10 days that you have either closed an account or opened a new account. It's Form AUD 101. Make sure that you go to the website, download that, and submit that. That is a requirement anytime you change banks or open or close an account. As far as naming the account, this is the list straight from the website of what you need, how you need to name your account. Several of the auditors have told me real estate brokerage trust account is a preferred way to name the account. And this is not just for the state. You want to make sure that this is named properly and set up properly at the bank so that if there is an issue and the IRS comes in to try to garnish your accounts, freeze your accounts, they know it's a trust account and they know that they cannot freeze that account for your personal debts or your personal obligations. So it's very important that you name that properly. A trust account is required for all owner money. The only exception to that is if the owner directs you to deposit the money directly into their account. Typically, there's two setups. And the main setup is the broker owns the account and the owners do not have access and the owners are not a signer on that. If you choose to do business, sometimes the big investment groups will say, hey, we have our own account. We want you to put the money in there. In that situation, that is okay. It's legal. But the broker does not have access to that account. They can't write checks, make payments out of that account. They have to submit invoices. They don't have access to that money. So the access is either broker has it, owner has it.
So just talking about how to name the account, the question that came up is one of the banks recently told one of our members that they can only mention trust or fiduciary in the nickname of the account and not on the actual name of the account. Is that good enough?
It's you need to make sure it's difficult. The banks are clamping down on this, and this has been something that's been a difficult thing for many people. I would suggest possibly even talking to a different bank. There are some banks that just flat out refuse to set up trust accounts, and I know that's frustrating. It's very frustrating for property managers. I know the department is aware of it. I have sent the Nevada email off to try to get something similar for Arizona so we can work with banks to help set up. The statute for Arizona is just what it says on the screen, that shall include descriptive wording substantially similar to this. So Since the statute says descriptive wording, if that's in there, you're probably going to be okay as far as the department goes. As far as the IRS coming in and freezing an account or that, I have seen that happen. I've seen other entities where the broker was a member of an LLC, and that LLC did not make payroll payments, and the government came in and froze the trust account, what they thought was a trust account, because it wasn't properly worded. So it is a big deal, and make sure that you have that set up. Not only that, you need to make sure that you have a copy of your signature card. One of the things that the auditors will ask for is a signature card, because the signature card is what they're going to look at, what the IRS and the lawyers are going to look at when they come into the bank to try to seize funds in that. So make sure you have a copy. After the account is set up, you can change the wording on it, have it mailed to a different place, say mailed to in care of trust account or whatever you want. So the signature card is key. Make sure you have that on hand. Hope that answered your question. I know it's not the great answer in what you wanted to hear, but I'm not in the banking industry, and the banks are nationwide and set up rules that are difficult for us to deal with, and that's unfortunate. As far as signers on the account, active licensees or unlicensed persons can sign on a property management trust account. Active licensees are pretty straightforward. For unlicensed, if they're in the direct employee of the brokerage, that's allowed. An independent contractor, a part-time CPA who comes in, that person would not be allowed to be a signer on the account. But if you have a part-time or full-time bookkeeper that is a direct employee, non-licensed of the brokerage, that's okay. Also, if it's a husband and wife that own the property management company together, and perhaps the wife is licensed and the husband is not, if they're a member or principal of the entity, they can be a signer on the account as a stopgap as well. Digital signatures and stamps actually are allowed. I would highly recommend that you do not do that. Having pre-signed checks, having signature stamps, having checks that print out with a signature already on them is a bad idea business-wise. It's a business decision. You can do it. The commissioner and the auditors discourage the practice, and they frown on that. It's really, really hard to ensure supervision if you can be out of the office on a Saturday and somebody can come in and print 15, 20 checks and have a digital stamp and walk off with the money that's in there. So I would recommend not doing that. As a broker, you are required to monitor the money in and out. You're required to supervise all the transactions out of the trust account. And one way to guarantee that is to make sure that you're signing that, or you've delegated that authority to another licensee, that you are still responsible to supervise that licensee's activities as well. Now we're going to talk a little bit about owner, broker, and agent-owned properties. Most of us that are in the property management industry also own some rentals. If you own rentals, you cannot have the funds from your rentals in the main trust account. They have to be in a separate trust account. It's considered commingling. And the department says that you have to have those in a separate account. Now this goes for the broker. It also goes for any agent under the broker. And it also goes for family. The rules apply, and there's a substantive policy statement from the department that I copied and pasted here by blood, marriage, adoption, including spouses, siblings, grandparents. That's the list. If it's an aunt or a niece or it's not on that list, then the rules don't apply. But the funds do have to be held in a separate trust account. Trust account, even though you own the property, you probably have tenant deposit money in there, and that is not your money. So it does have to be a trust account if it's run through the brokerage. So if the brokerage has 100 owners that they work for, and they also have 3 agents who own property, the 100 owners would be in one trust account. The 3 agent money could be in a separate trust account. It can either be one trust account with all the agent and broker properties and money in there, or you can have an individual account for each of those agents and or the broker. So this is a sticky one. I know lots of people weren't aware of this and haven't been following this, but it's critical, and they're asking these questions and making sure that you don't commingle on that. One other sticky situation is the licensee cannot be a signer on that account. At our company, we have 24 licensed agents. I own rental property. My properties are in a separate trust account along with the other agents. I am not a signer on that trust account because I'm the owner, and either the broker can be a signer or the owner can be a signer, remember? So the only difference in this, the designated broker is the exception. The designated broker is allowed and probably should be a signer on all of the accounts since they're required to supervise all of the accounts. Let's talk about how to use the trust account. You're going to have owner's funds, tenant funds, brokerage funds in there. Commingling. Now, a lot of people say commingling is illegal. Well, that's not necessarily true. We have many, many owners and all of their money is one account. That's commingled. It's all in the same account, and that's perfectly fine. You have to be aware of what's legal and what's illegal. You're allowed to have up to $3,000 of your money in the trust account when you establish it. That's commingling, but it's allowed. You have that money in there to cover incidentals, bank charges. If a bank cashes a check for the right amount, we've all had this situation where we wrote a check out for $917 and a bank cashed it for $971. Well, that $64 difference has to come from somewhere, and if you don't have some money in the account, it's going to pull from one of your other owners and make them go negative, and that's not okay. So it's a good idea to have a little bit of money in there, and this all depends. It's a business decision. It depends on the size of the company, the normal amount of errors that you have on the bank, the normal amount of fees that come out. So that dollar amount can be up to $3,000. It doesn't have to be $3,000. It can be $200, $500, whatever you choose to have it be. Now, brokerage funds must be removed at least monthly. Interest must be removed at least yearly. Well, typically, if you have a retained balance and you've made your business decision that you're going to keep $500 in the account, at some point each month, you need to sweep that account down to $500 and pay yourself everything but that amount. So your beginning balance would be $500. After you reconciled and paid yourself, your ending balance would be $500. Records rules. As far as owner money, money can only be used for the purpose for which the money was deposited. If the owner sends you a check and says, this check is for new carpet, you can't take that check and use it for something else. You can't pay yourself fees. You can't do anything else with that. Now, typically, that doesn't apply very often. It does occasionally, but most times we have a reserve account on for the owner, and that's fine. You need to make sure that you have listed what that reserve account can be used for, whether that's just for emergency repairs. Is that allowed to be used for an HOA fine, allowed to be used for taxes, a license fee, anything else? So if you do have a reserve account, make sure you have a list of what that's allowed to be used for. Also have to keep a complete record of all monies received in connection with the transaction. It should say when it came in, how it came in. Example, whether it's a check or a money order, whether it's a digital transaction. It should say what it was for, which account it went to. Broker records also need to be kept according to GAAP. Now, GAAP is not a store where you buy jeans. GAAP is generally accepted accounting policies and principles. If you Google that, you will get thousands and thousands of pages. In a nutshell, what it says is that you treat transactions the same. If it's income, call it income. If it's expense, call it expense. Don't call rent income sometimes and call it expense sometimes. Don't call plumbing an expense sometimes and income sometimes. It's an expense. If you treat all the transactions the same and you set that up, you're going to be okay. But make sure that you do that and that you follow at least a general guideline, and that's normally done through your accounting software. That will cover that for you if you don't monkey with that too much. Also, ADRE requires that you maintain bank reconciliation and client ledger reconciliations every month. We'll go over that here just in a second on a three-way reconciliation. We'll talk about that. 2151.2 says that you are not permitted to advance payments of monies belonging to others. And what that is that's talking about prepaid rents. You can't have prepaid rents, take those commissions early. The department says no against that. That's you can't do that and commingle those with personal money from the broker. Let's talk about illegal commingling for a minute. Illegal commingling, let's say that you manage for 10 owners, and that's all you manage for. Each of those owners, their house rents for $800. Each one also has a $200 cash reserve. So you have $1,000 for each owner. That's $10,000 in the account. A bill comes in for a new AC for $4,000, and you write the check, and the vendor cashes the check, and you've paid the bill. Well, now when your bank statement comes, your bank statement is going to show a beginning balance of $10,000, a cleared check for $4,000, and a balance of $6,000. You reconciled, you balanced, so you must be okay. No, you're not okay. One of those owner's ledgers is negative $3,000. That's not okay. It's actually a negative $3,800 because the tenant's money is not owner money. The tenant money during the term of the lease is the tenant's money. You cannot use that to pay bills. That's the tenant's money. It does not belong to the owner. So in order to reconcile and make sure that there is no illegal commingling, you have to make sure that you do a three-way reconciliation. We're going to talk about that here in just a minute. If you're following general trust accounting rules, you should also have no negative balances. You cannot draw and spend money that you don't have yet. You have to make sure that you have the cash on hand and that the funds are good before you write checks. And we'll talk about that a little bit when we talk about accounts receivable. Quick note on inactive clients, as long as the money is in the trust account, all of the trust accounting rules still apply. So make sure you clear those out in a timely manner. Make sure that if you have a tenant that didn't cash their security deposit refund check of $17 or whatever it was, that you deal with that. Get that out of the trust account. There's several different ways to do that. You can send that into the state as unclaimed funds. You can have a cashier's check made out at the bank, so the bank is responsible for it to the tenant. But you need to clear that out of there. You don't want in your trust account a lot of old checks from 5, 6, 7 years ago. The auditor will discount those checks, and that will make you be out of balance. So a lot of uncleared either deposits or checks that are quite old is not a good thing, and you need to make sure that you take care of those. We talked a little bit about reconciliations, and a three-way is the only way. And again, if you go to the ADRE site, they've got several forms and several packets on how to properly do this. I've copied it straight from there. I'm going to show you what it looks like. And a three-way reconciliation is absolutely required. It's required every single month. You have to do it, and the designated broker has to sign off on it if the designated broker is not the one doing the reconciliations. So if you're paying someone to do those, that's great, but they need to submit that to you and need to sign that and have it on hand so that when you do have an audit, you can go back and say, yes, the three-way was done. I have the money that I'm supposed to have on hand. Well, here it is in a nutshell. Most people balance their bank statement to their software. That's great, but that's a two-way reconciliation. Think back to the example I gave when you write the check for the AC. The check's balance, the bank statement balances to your check register, that's fine, but you don't have enough money, you're upside down. The only way to prove that is to do that third leg. So first step, you balance your bank statement. I hope everybody's balancing their bank statement every day, but you balance it to your software. There are things that the bank doesn't know about, checks that you've written that they haven't cleared yet that they don't see, deposits that you might have done last day of the month and you just didn't get it to the bank in time. That stuff happens, that's fine. You're going to have an adjusted bank account number, and here's what that looks like. So your bank statement ending balance, less checks, plus deposits, you have an adjusted amount. And if your checkbook software balance is the same, the difference should be zero, and you should balance to the penny every month. It's something you're required to do. If there are transactions and something happened, didn't clear right, you need to post offsetting transactions and make sure that you do balance to the zero. It's not okay to have a difference there. Now let's talk about the next step. The only way to prove that out is to have individual ledgers, not a grand total, but individual ledgers for owners, tenants, and brokers. All of that money is the only money that's in the account, and they should equal that same amount. So I'm going to do some examples on that. Owner funds, tenant funds, other trust funds would be your $3,000 balance. It might be some tax liability accounts. There could be some other money in there. But all of those have to balance with what your bank statement says, your adjusted bank balance. Owner funds, cash, obviously your reserves. You have a reserve. The reserve could be zero. The owner could have no cash. Most companies have a small reserve on hand to cover any bills that come in, that kind of thing. Liability accounts. Liability account would be the owner has a fourplex and the roof is going to cost $6,000 and he just doesn't have the money right now. So he asks you to set aside $300 a month until he has enough money. That would be a liability account. That's another example of where the owner has directed you to set money aside for a certain purpose. You cannot use that money for any other purpose without direction from the owner. So if he says set aside $300 for a new roof or a new parking lot or whatever it is, that's roof money. That can't be touched for anything else without the owner's okay. If something comes up and you ask the owner and say, hey, I want to dip into this, and they agree to it, that's fine. Again, tenant deposits are not owner's funds. If you go to the department websites and look up frequently asked questions, this question comes up all the time. It's under property management, and it is very clear directly on the department's website that the tenant money belongs to the tenant during the term of the lease. It's a great link to have. I would save that. Any of your owners that want to dispute that, dip in, use that money to pay a bill, direct them there, and then it's not you being the bad guy. It's the department telling them it's not your money. Let's talk about tenant funds. Security deposits is the big one, but they may have other refundable deposits. They may have advance payments. You know, that tenant that has a $9.95 rent that pays $1,000 every month. You have to account for that $5. You can't just take it. It's not your money. You can't do the late fee happy dance. It's their money, and you have to account for that. Management, other trust funds, fees collected waiting to be paid, your cash reserve, tax liability accounts. As you collect tax from tenants, that payment isn't made until the following month typically. So that money may accumulate in there, and you have to account for that to make sure that you balance. Other liability accounts for management funds are not a normal practice. That would be either non-refundable deposits or a non-refundable fee that's being held under the management ledger. I've seen it done. It's not illegal, but it's not a normal practice under GAAP. We're going to go quickly through an example of how to do a three-way reconciliation. This needs to be done as of the bank statement date in order to prove it out. You can't do a three-way reconciliation on the 15th and balance your bank statement on the 31st. It just doesn't work. They have to all be for the same date. Typically, most banks, that's the last day of the month. So here's an example using 21-177-81. Y'all have your calculators out? I'm just kidding. No, you won't need them. But we'll show you what that comes up to and why that's important. So first, here's owner's funds. Available cash, those are the reserve amounts, 200, 500. Then we have a liability account. You'll notice these are all president's name. Mr. Lincoln has a $400 termite warranty set aside for his log cabin. He's going to need treatment there. So you have $3,000 total owner fund, mostly available cash in a reserve account and $400 in a liability account. Now you may have many liability accounts. Some property management companies never use a liability account, and that's okay. It's perfectly fine. Now let's talk about tenant money. We have all of our tenant security deposits that total up to $13,595. We have one tenant that has a $3,000 advance payment paid a year in advance, 6 months in advance, and that happens, that's okay. We have another tenant with $40 in open credits. He's just paying an extra $5 every month. So you have $3,040 in overpayments and advanced payments from tenants, and you have $13,595 for security deposits. Now let's talk about management funds. Management ledger, this particular company has decided $500 is enough to cover all those incidentals, so that's fine. You have a little bit of tax money in there, total of just over $1,500. And when you do your three-way reconciliation, you're going to take those dollar amounts and add them together. And you'll see that the total client liabilities, 21,177, matches the bank adjusted balance. And you are required to do this every month. You have to have the details. You can't just fill out this form and say tenant funds 16,635. You have to have the details of what the tenant funds are, who they belong to, and where you're coming up with that number. A summary number for those is not acceptable for audit purposes. So this should be done every month. The form is on the ADRE website, and that should be signed by the broker every single month. And keep a copy of those. They're going to ask for them and want to see those when they come in and do an audit. And again, it is required. The beautiful thing of this, if you do the three-way reconciliations correctly, and you have printed off all of the backup documentation, you cover 8 of the 14 items that the department asked for during an audit. It's a beautiful thing. So if you're doing what you're supposed to do and you have those reports and you have those all printed and ready to go, you have very few other things, your property management log, and they're going to want to look at a standard PMA and a standard lease. But those are easy things to come up with. The accounting stuff, if you're doing a proper three-way reconciliation, covers 8 of the 14 items. So you got to do it. You're required to do it. It's going to save you when you come to an audit. So there you go. All right, let's talk about accounts payable. Trust account distributions. We've got a little survey here we're going to do that is going to ask what's allowed, what's not allowed out of the trust account. And so answer that as to what you think is allowed to be paid directly out of the trust account, because there are rules on that, and you can't just pay anything out of the trust account. So we'll give you a second or two to answer.
And the question is, which of the following payments are allowed to be paid directly out of the trust account? Is it commissions to licensees, reimbursement to agents, like for keys being made, referral fees to other brokers and agents, or none of the above? So pick one of the answers. So currently, it's mostly none of the above, but we do have a few people who think reimbursements to agents.
So we'll go ahead and close the poll down now. It was 85% and 15% it looked like.
Yeah.
85% said none of the above, and 15% said reimbursements to agents. Actually, reimbursements to agents is the correct answer. You are allowed to do that. Now, I will tell you, the auditor frowns on that. Typically, when they come in and audit your books, they're going to go through your check registry to look for payments directly to agents. And every time they see one of those reimbursements to an agent and they see a licensee's name, they're going to ask, it draws a red flag, and they're going to ask, what was that for? And where's the backup documentation for that? So although it's allowed, it's probably not one of the best practices. So minimum details for all payments. Anything going out needs to have the date, the check number, the dollar amount. It needs to have descriptions of what it was for. You cannot write a check for $15,000 that just says general expense or miscellaneous expense. That is not okay. What happens a lot of times, if an owner sees a small amount, $65 general expense, they may know what it is. You may have had a conversation, and that's okay. But believe me, come the end of the year, when their tax accountant gets that and sees that over the last year you paid $3,000 in miscellaneous expense, there will be a problem. So make sure you're tracking all of that stuff and that you have the details to back it up. You are required to have an invoice or a receipt for every payment that you make out of the trust account. Something that you have in a file, you have to keep that for 3 years. We talked about that. But it has to detail who you paid, why you paid them, what it was for, dollar amount, and where it came from, which ledger it came from. That's just the minimum details. And again, your accounting software probably has all of that information in there. So as long as you're being diligent when you're putting it in, garbage out, put all that detail in on the front end and it will track it for you. You have to follow GAAP. You cannot make payments out using income codes, just not a good idea. You also can't exceed the owner's available cash. So if the owner only has $200 and a bill comes in for $205, you can't pay the bill. You can pay a partial, but you cannot pay the bill. You can't make the owner go negative even a penny. It's not standard trust accounting, and it's against department rules, so you can't do that. Let's talk for a moment about mortgage, tax, and insurance payments, particularly mortgage. And we're talking property tax payments on here. I should probably add that in. There is an extra degree of fiduciary responsibility if you choose to make any of these payments on your owner's behalf. Now, I don't know, I can't do a raise of hands to see how many of you do that or you don't. There's probably a few of you who do. But the thing that you need to think about when you choose to do that for an owner, and it's perfectly legal, you can do it, but what if the check is lost in the mail? Now, the owner has late fees on their mortgage and also possibly a ding on their credit because of something that you did. Who pays the late fee? Is that in writing who's going to pay the late fee? Is it in writing that if the check gets lost and there's damage to their credit that you're covered for that? If you choose to do those things, make sure that you're covered for that. Make sure that you have enough money on hand. If the tenant doesn't pay the rent, do you have enough money to make the mortgage payment? And if the mortgage payment isn't made because you didn't have the money, who's responsible for any fees or problems or issues that arise from that? That language has to be in your management agreement. Make sure you do that. Then it's a business decision. You can absolutely choose to make those payments. That may be a service that you offer and it gets you more owners. Great, that's fine. Just make sure you cover yourself on that, because there is an extra level on anything that can cause a lien to be put on the house, cause late payments, cause any type of, an insurance cancellation, that type of thing. You need to be careful with that. Details. We talked about this. You have to have those details on every transaction. It's required, and you just need to make sure that you have that on there. Owner reserve usage, we talked about a little bit. If you do have a reserve account on hand, make sure your management agreement defines what you can use that money for. The AAR management agreement does a pretty good job of that. And I'll take a minute to let you know AAR has a lot of standard forms out now that are available. You may not know they're available on zip forms, and it's some great stuff. There's a standard lease, a standard management agreement, lots of other standard forms. I would highly recommend you go at least look at those if you choose not to use them. Some great stuff. They've all been vetted by the attorneys and gone through the system. So go look at those. They're there for your use. We talked about this, commissions and fees. Reimbursements to agents is okay. None of the other ones is allowed. You cannot pay commissions to licensees, any type, late fees, NSF fees, any other fees. You cannot pay out of the trust account. It's got to go from the trust account to your operating account, and then out of your operating account to either one of your agents or a referring broker. I'm going to talk about rental tax. This is changing. I've got a meeting tomorrow that I'm going to, and hopefully we'll have more information. Arizona Department of Revenue has quite a bit of information on that. We're going to go through this pretty quick because we're running a little low on time. Property management paying. If the property manager pays, there is a master license that they have, and that puts some of the liability on the property manager. So if you're going to collect those and pay those, you do share in the responsibility. If you collect those and send those off to your owner and have your owner have a license and pay, then your owner is responsible. Gross income from business activity is taxable. There's a lot of questions come up on this, so I want to make sure that I cover it. There's a list of what is specifically covered in the Model City Tax Code of what is taxable. Any money that goes from the tenant to the owner is taxable, period. The biggest one is tenant security deposits. When you retain a tenant security deposit for cleaning, carpet cleaning, drywall damage, that is taxable every time in every city. So make sure that you're processing it properly so that you're audit compliant. You can either have cash or liability. I'm going to flip through these pretty quickly because this is going to change. Best practices: use your software. Don't monkey with your software. Restrict access to who can and cannot enter stuff into your software, and have good written policies and follow them. Now, accounts receivable is very similar to accounts payable. Minimum details is the same. Deposit slip have to have all of the information on them, just like accounts payable. You have to track all of that. On accounts receivable, funds must be deposited within 3 business days. Now, on the sales side, there's a lot of stuff that's immediately, but 3 business days on a property management side. The only exception is disputed funds. If the tenant owes you $1,000 and they drop off $100, you're not required to take that money, but you are required to notify them and send that back to them within a reasonable amount of time if they can't get that cleared up. So if they drop off funds, you contact them, they sign a promissory note, you can then take the funds, that's fine. If you don't hear from them, don't hear anything, you have to send the money back within a reasonable amount of time. Forms of payments. You can take all different kinds of payments. I would caution you against cash. If you do choose to accept cash and that's a business decision, make sure your insurance company knows that you are accepting cash at your place of business, because there's a different level there. If you have cash stolen from the business and your insurance company doesn't know, you may not be covered and you may have to write a check to cover cash that was stolen. Good funds, up to 10 days for checks. Make sure that you're not making payments out of the trust account until funds are good. And I highly recommend you have company receipt policies. If a tenant pays short, you want to have written policies about how much is acceptable and how much is not. If they pay $1 short, do you take it? What about $100? What about $200? There has to be a limit, and that should be written and followed consistently. So again, 10 days after depositing for funds are available. If you get a check today and you send your owner money tomorrow, you may be in violation, because if that check bounces, then you're commingling, you've gone negative. Ways to reduce that: online payments, scheduled automatic debits, credit, debit card payments, check scanning, digital deposits. Those are all ways to cut down on that 10-day bank float. But you do need to make sure that the money is good before you send funds out for anything. Again, written policy on when you receive, and it should cover all of these things. So make sure you have that. Make sure you follow it. That's going to save you not just for the department, but for fair housing and all of the other legal things that you have to follow and be covered for. So there you go. Sorry to go through that last little bit a little quickly, but I can sit here and talk for another 2 hours about accounting. It's my passion. I hope you guys learned quite a bit, and we'll take a couple other questions if we have any and go from there.
Okay, so I'll be going through the questions as we continue. In the very beginning, you mentioned that it was okay for our members to contact you with questions.
Yes.
Email address?
Email address is Mike, M-I-K-E, @ Bennett, B-E-N-N-E-T-T, the number 2, rentit.com. And email is absolutely the best way to get a hold of me. So,
okay.
And happy to help.
Well, thank you. Within the next few hours, I'll send out an email that includes all of the links from today's webinar. So you can have all those ADRE links and the ones from the very beginning, and anything that Mike noted during today's presentation, I'll send out to you. So specific questions about property management, record keeping. You were talking about the record keeping and the folders, having a folder available. Is there a difference between having an online folder or having hard copies?
There is not. Either one is acceptable, but it needs to be in such a manner that the auditors can go to just that folder and look what's in that folder. So what happens is, typically during an audit, they will come in and say, show me the list of all the properties you manage. And they're just going to randomly pick 3 or 4 of those and say, show me the folder for that. So you can either have a digital folder and say, here's the folder on the computer that pertains to that property, or go to a file cabinet and pull out a hard copy folder and hand it to them and say, here's the folder with all the paper in it. Either one is fine.
So they're equal. There's like one's not preferred over the other.
No, they're fine. Now, I will tell you, when they come and audit, they're going to want most everything in a digital form to take back with them. So if you already have everything in a digital form, it's going to be easier for you to comply with that. You don't have to scan a whole bunch of stuff for them. So, but equal either way. That's a business decision, and either one is fine.
So, and kind of what I hear too is, if you're in property management, it's not a matter of if you're going to be audited, but when.
They have said, and they've said it for the last few years, that they're going to come audit every single property management company in the next 2 years. Now, they said that 3 or 4 years ago, and it hasn't happened, but I will tell you, it has ramped up. We have seen a lot more audits come through. And if you guys are not on the alerts that come out from the department, I would highly recommend that you do that. I go through that. I love the honor roll that they do. I think that's outstanding that they're recognizing the people doing it right. But they also have the people with the cease and desist and licenses that have been canceled. And a lot of people call those the obituaries. But if you go through there and read what they've done wrong, it's very helpful for you to go, oh, gosh, I don't know if I'm covered on that. They got a $2,000 penalty for that. Guys, are we covered? So it's good information. I would highly recommend you do that.
Okay. So one of our questions, when owners keep the security deposits themselves and handle their own repairs, what are the key auditor requirements for something like that?
The key auditor requirement on that is that you have to designate in the management agreement and in the lease where the deposit is. So if the deposit is being held by the owner, the lease and the management agreement both have to say the deposit is being held by the owner. You have to notify the tenant that the owner is the one holding the deposit. That's a business decision. You as a realtor are required to treat your tenants fairly. Your owner is the client, but your tenant is also your customer. So you cannot just willingly do something that's against the law. You can't have your tenants living in a house with no AC because the owner won't send you a check. You're still kind of on the hook for that. You have to treat them fairly. So in the instances where the owner is holding the deposits, as property managers who have done this for more than 3 months, any of you out there, you will know your owner's going to say, well, he lived there 6 months and he owes me for the full paint job. Well, it's probably not normal wear and tear. So that's a business decision you just need to be aware of.
No, very good. And then property management seems to be just a really hot trend. I know that we teach a lot of property management boot camps. Mm-hmm. And I know that we have a lot of members who attend those 2, 3, 4 times because it's always nice to know what you're doing, maybe what you shouldn't be doing. Any hot topics that you see?
Oh, gosh. The trust accounting, like we talked about, that's why it's the biggest part of my presentation. Mm-hmm. The money missing from the account is much, much harder to overcome than anything else. If you're missing a lease, if you have a clause that's missing out of your management agreement, those are much easier items to overcome. If the money's missing, there are huge consequences to that. So that is the absolute biggest thing. The security deposit, matching, missing clauses in your management agreement, make sure that you go through that and make sure that all of the required clauses are in your management agreement. Those things are the big ones that I've heard of.
That's excellent. Well, thank you so very much, Mike.
Sure.
Any last closing words, words of caution, words of good news, anything you'd like to close with today?
Well, one of the things I'll mention is one of the things that AAR is doing. They're coming up with a new property management certification, the CRPM. It's been announced. It's on the website. I would highly recommend going and looking at that. It's for professional property managers who want to distinguish themselves and set themselves apart. There is some required classes. The boot camp is required for new property managers. The trust accounting classes are required. But if you take the classes to get the certification, you also meet all of the requirements for your 24-hour renewal process. So you can renew and also get this certification. And I think it's a great idea. Like I said in the very beginning, the department is focusing on 2 things. 1, compliance and coming after the people that are stealing the money. But 2, education to make sure the rest of us are doing it right. And this is a big piece of that. And AAR is doing a great job, I think, of getting the needed education out there to those of us in this industry. So good stuff.
Absolutely. So anybody interested in the CRPM designation, you can go on our website at aaronline.com. And for a complete list of upcoming classes, you can go to aaronline.com/calendar. And you'll see that the property management boot camp is coming up in 2 different places, and as well as the anatomy of the property management transaction. So great classes. On your screen, you're going to see that we have the Industry Partners Conference coming up. Of course, everybody wants to talk about TRID, all the changes, so we invite you to join us on September 16th as well. As mentioned earlier, today's webinar has been recorded and will be available on our website. Give me just a couple of days to do some editing, and we'll have it available for you. It's online, aaronline.com/increase-knowledge. And at the end of today's webinar, a survey is going to come up. If you would just give us some feedback on what you thought about today's presentation. Did you learn everything you thought you were going to learn? Do you still have questions and things that we can answer for you? Please let us know. If you have a great idea about a webinar topic, I'd be happy to create a webinar just for you. That's how we have some incredible webinars coming up about lead generation and conversion and TRID, because it's of members like you who tell us what you're looking for, and we are happy to serve you that way. So folks, thank you so much for joining us today. Mike, thank you so much for being here.
You're quite welcome. Thanks, everybody, and hope you learned something. If you have any questions, shoot me an email.
Sounds great. Thank you very much, folks, and have a great day.